Daily Market Update 21st of July. If you like these segments, please like and subscribe to receive our new content. Also, consider visiting our website at www.fxhunterwealth.com to view our copy trading service offering. USD overbought in the short term, buy the dips. In the short term, the USD and JPY are overbought, and as per yesterday's update, Bloomberg states that stocks in Europe climbed a second day along with US index futures as a slew of corporate earnings took the focus off concerns about the economic impact of coronavirus flare-ups. Treasuries slipped and the dollar strengthened. We don't see a big upside in stocks and expect them either to chop sideways or have a major sell-off. If we do get a big sell-off, this would give additional support to the USD and JPY. Mike Wilson from Morgan Stanley says the market appears ready to take on a more defensive character as we experience a meaningful deceleration in earnings and economic growth. Market breadth has been deteriorating for months and is just another confirmation of the mid-cycle transition. In our view, it usually ends with a material index level correction ranging between 10 and 20%. We agree, and if we move lower, we expect the USD and JPY to move sharply higher. The USD and JPY will also be supported by the fact that the Fed will withdraw stimulus and raise rates quicker than the market expects due to inflationary pressure. Low interest rates, huge Fed stimulus, and nearly $6 trillion in government relief since the pandemic started in March 2020 are fueling demand, straining supply chains, and rising prices across the economy. The idea that inflation will just cool off isn't going to happen. In our weekly report, we already saw more money go back to the Fed via reverse repo rates than entering via stimulus. We expect it to be cut this year, not next, and this will support the USD. Rabobank released a statement saying, there is a clear safe haven element behind the stronger tone of the USD. This is demonstrated by the fact that the JPY is the only G10 currency to have outperformed the greenback. Not only is there the potential for the USD to stay on the front foot in the coming months, but there is scope for the euro to soften. We have the ECB coming up on Thursday. The ECB's current guidance is that it will buy bonds for as long as it deems necessary and keep interest rates at their current record low until it is happy that inflation is converging to its target. There is a problem: even if inflation moves to target, the indented southern nations can't take higher interest rates. Portugal's Mario Centeno and Italy's Ignazio Visco have come out in force to argue that the new strategy means the ECB should keep stimulus going even if inflationary pressure is at or above the ECB's target. Our view still is that the ECB can't cut stimulus in the near future. The market expects further stimulus and will get it. The southern poorer nations are also about to take another hit, with CNBC reporting Europe is struggling to contain a surge in COVID-19 cases caused by the Delta variant. But while several countries reimpose measures to control the spread, the UK is taking the plunge and lifting restrictions. The UK is making the right decision in our view, but the Eurozone is being more cautious. France, the Netherlands, Greece, and Spain all announced new restrictions on Monday in a bid to curb the rise in COVID infections, and Dutch Prime Minister Mark Rutte admitted on Monday that restrictions had been lifted too soon. Restrictions in the southern countries, which are desperate for tourist revenue, are a crippling blow, and countries like Spain is in deep trouble. The Eurozone is not going to have a broad-based recovery in terms of economically in our view, and these restrictions add more pain. There is no end to stimulus from the ECB inside, and the euro is going down in our view. Enjoy the rest of your day. Happy trading.